public markets, private markets, long, short. But talk a little bit about today's CPI number, how it filters into the, I guess, general working assumption you have for what kind of economy we're in and what the Fed's going to present us with.
I don't think it changes our long-term working assumptions much. I think from the Fed side, they have more latitude to go harder after waiting so long to go at all. And so I think we're on a bumpy road to normalization. We're doing that at breakneck speed, and all things need to normalize, whether it's money supply, fiscal policy, and just demand trends that companies have got used to that are changing, at a rapid rate as well. So with uncertainty comes volatility. It's not meant to be a smooth ride. It's been rather easy for very long. And as a fundamental investor, I think we're super excited with believing that details matter again, and how this all plays out will be very different. It's not just how long and how low will interest rates change. I think the conversations we're having with our companies are very nuanced and will lead to very different results.
You mentioned demand trends that some companies got used to. There is this sense out there that for across many, consumer goods areas or whatever that might be, that they kind of over-earned through the pandemic and maybe extrapolated some of those trends. So that's got to create opportunity if you have winners and losers getting separated out of that. What areas, what kinds of companies work there?
Look, I think we're in an environment where we've had this unprecedented demand surge that was impossible to plan against. There isn't a business I'm aware of that didn't receive a COVID bump. Some have happened in 2020, 21, if you're in the restaurant business, and maybe happening right now, and deciding how much of that demand you want to capture versus and change your cost structure versus not, I think is really challenging. For us, we want to be with businesses on the consumer side that have a strong brand where people are engaged with, whether that be a Nike or a Sweet Green. We want to be engaged on the consumer side with businesses that set price and get price, whether that's Amazon or Walmart or TJX, which I think is going to be a major beneficiary from this glut of supply and inventory you're going to see as you continue to head into Christmas. I would say it's been a couple of years since you could find a discount over the Christmas period. If for some reason you've held off buying the flat screen TV, or you haven't invested in the barbecue for the backyard, or you haven't bought your favorite apparel stuff, this will be the year where you're going to get, I think, quite remarkable discounts as companies work through, the oversupplied inventory problems. And then away from the consumer, I think we want to own, for the long term, mission-critical businesses. We call those beyond privileged and resilient. They have tremendously tight customer retention ratios. They've grown through COVID. They've had a COVID bump as well. So there's some normalization that needs to take place as well. But whether that be a Workday, a ServiceNow, or a Paycor, these are businesses that are deeply embedded within their enterprise clients.
And those would be examples of businesses that, the stock prices certainly have moved a lot more than the businesses have changed, most likely.
I think there's a debate there.
Yeah.
In general, I think by and large, the adjustment you've seen in equity values has been a reflection of the 10-year, starting the year at 1.5 and 3.5 today. I would just highlight that's only half the move you've seen on the front end, right? The front end's moved over 300 basis points. I'd say by and large, share prices reflect changing discount rates and haven't yet baked in potential change in earnings.